Contrarian investing is a strategy that is characterized by the sale and purchase of securities which are in contrast to the prevailing sentiment of the time. In simpler words, if everybody else is buying, then the contrarian thinks of selling, and if the majority is selling, then he or she is looking to buy. Essentially, a contrarian believes that an investor crowd's behavior can lead to exploitable mispricings in the securities market. For instance, we often come across popular pessimism about a stock or a sector which can drive its prices so low that it ends up overstating the risks and understating its prospects. Take, for example, the pharmaceutical sector. Now, for many years, the Nifty Pharma has been operating at an average price-earning ratio of 44. Then, starting April of 2019, reports started rolling in of lower growth in the US markets, which was soon followed by news on regulatory issues, pricing pressures, and delays in launches of some drugs. Now, even a speck of bad news is enough to worry people, and here we were receiving one bad news after another for weeks to come. And this was more than enough to push down the prices of most pharmaceutical companies, and the PE ratio of the pharma index dropped down to 28 by October of 2019. In fact, until one day before the market tanked in March of 2020 as a consequence of the coronavirus pandemic, the Nifty Pharma PE ratio was just 20 against a long-term average of 44. Now, you really don't have to be a contrarian to know that when the pharma index P ratio goes down to 20, the investor community as a whole was overstating the risk by so much that investing into the pharma sector was no longer a risky affair. But to make the point even more stronger, during this period from March of 2019 to March of 2020, when the pharma index had gone down by 20%, its earnings per share had actually gone up by about 50%. This mismatch was identified by few investors, mainly contrarians, who then ended up making above average gains. Now, I don't want to give the picture that contrarianism is about going against the consensus. And I say this because in common parlance, people think that a contrarian is someone who stubbornly disagrees with anything and everything. So if we can put it as a list, the cornerstones of a contrarian strategy would include a willingness to dispute conventional wisdom, the capacity to demonstrate creativity, a high level of conviction, the ability to see further beyond the pale, and a deep desire to identify and rectify inaccuracies in prevailing paradigms. To put it succinctly, contrarian investing requires a combination of patience, discipline, superior research, and conviction. Of course, for followers of this strategy, the benefits come in the form of enhanced performance, reduced volatility, less overreaction to market developments, and a greater focus on owning genuinely attractive holdings. So if this sounds interesting to you, also check out the description section of this video where we have listed some of the articles, books, and other reading materials that we have used in the research and creation of this video. As a general principle, following the crowd almost always works. Like if you see a dozen people standing in a line at the bank, you are very likely to join them, assuming, and probably rightly assuming, that there is a proper reason why these people are standing in that queue. However, in investing, prudence calls for us to do the exact opposite. For instance, say you're trying to buy a share at the lowest possible price. And that makes sense because lower the price, the larger are the gains. But if you look at it a level down, then one would realize that a lower price can only happen when other people are selling. This is an important point, and essentially to get that bargain price, one has to look in places where the public is most frightened and pessimistic. John Templeton calls this the principle of maximum pessimism, which says that to produce a superior performance, one has to do things differently from the majority. A second reason why contrarian investing works is on account of the poor forecasting record of those so-called experts, equity analysts, stock gurus, the people we often see on business channels, etc. In that context, David Dreman, who wrote the book Contrarian Investment Strategies, conducted several studies comparing the analysts' forecasted earnings with their actual earnings, and over a 20-year period found that the average analyst was off the mark 42% of the times. Likewise, there is also a paper which was published by the Indian Institute of Management, Bangalore, which found that the target prices given through analyst recommendations reached their target only in about 43% of technical calls and in just 52% of fundamental calls. In essence, a guiding principle of contrarian investing is not to spend a lot of time tracking analyst recommendations, but to constantly question the assumptions, conclusions, and perceived wisdom associated with the consensus view. A third aspect that supports contrarianism is its tight relationship with value investing. You see, both these practices are looking for the same thing, that is, mispriced investments which are deliciously cheaper than what they are actually worth. But unlike a purist value investor, a contrarian investor often looks beyond financial metrics and also factors in sentiment measures like analyst coverage, earnings forecasts, trading volumes, and media commentary, which gives indications of how the crowd is likely to turn in the future. Net-net, contrarian investing is about the working together of numbers and sentiments. The first contrarian investing strategy is a very obvious one and involves investing in something that others aren't doing. For example, when the economist John Maynard Keynes managed the King's College Endowment Fund, he advocated investing in domestic and international stocks. This was a stark departure, as most university endowment funds of the 1920s and 30s had invested their money almost exclusively in land and fixed income assets. This contrary approach allowed Keynes to outperform other endowment funds by over 6% over a couple of decades. And if we draw parallels from today, this approach can involve the use of distressed debt, real estate investment trusts, investing in Africa, green projects, commodities like silver, etc., where the crowd has not really participated in full force. Of course, this definitely carries some extra risk of the unknown, and that's where a contrarian's effort and interest in deep research would come in, as he or she would look to narrow down those opportunities where the probability of return overtly exceeds the risk. A second commonly used set of contrarian indicators, particularly around investor sentiment, are the volatility indices, or VIX as it is generally known. Now, a VIX, by tracking the prices of financial options, gives a numeric measure of how pessimistic or optimistic the market actors are at a particular moment of time. A low VIX indicates an optimistic and confident investor outlook, which would make the contrarian examine and re-examine his valuation premises. Conversely, a high VIX indicates a pessimistic outlook, which would often spring the contrarian investor into action as he or she uses the crowd's fear into one's own advantage. Another example of a simple contrarian strategy is what is popularly known as the dogs of the Dow strategy. Very simply, this strategy is about purchasing a certain number of stocks that have the highest relative dividend yield. So while the original strategy was layered around the Dow Jones Industrial Average and with 10 stocks, if this is done with the Nifty 200, our present day dogs of the Nifty would include stocks like BPCL, Indian Oil Corporation, Indus Towers, Hindustan Zinc, Petronet LNG, etc., each of whom presently offers a dividend yield of over 5%. Now, what's commonly seen with this strategy is that mostly one would be buying distressed sort of companies which come at a low P ratio and a low price to book ratio. More starkly, many of them would be struggling for revenue growth and might have delivered negative stock price returns to their shareholders. In other words, the dogs are the least loved stocks in the market, which for a contrarian can be a wonderful use case to buy them and patiently wait until the market starts loving them again. The next contrarian strategy revolves around human behavior in the sense that the mind cannot focus on too many things at the same time. In that context, the stock market is no different, and at any given time, we'll see a few sectors taking the limelight while a few other sectors are left back in the pool of ignorance. For example, and presently, internet aggregators seem out of favor, with the sector in totality having lost 30% of its value over the last 3 months. And while that's bad, ports, tires, and the insurance sector have been in the wilderness for an even extended period of time. For a contrarian investor, these moments warrant additional research on their part to understand if these dips are nothing but temporary pessimism, or are there any structural shifts which are happening which will then make it easier to decide whether to invest or exit a sector. Yet another contrarian strategy that practitioners employ lends its genesis to Templeton's point of maximum pessimism. And there are quite a few things which are happening around the world as of now. For instance, the Russian stock exchange was closed for a few weeks on account of the Ukraine-Russia war. And just today morning, the Colombo Stock Exchange had to halt trading after the stock market had a sharp fall within seconds of opening. Now, most investors are not temperamentally equipped to buy when there are tanks and angry citizens on the streets, or when the currency is collapsing, or when there is acute inflation, etc. However, for a contrarian, this presents a wonderful opportunity like what John Templeton did in 1985 when he invested in Peru at a time when the combined value of all Peruvian stocks was less than $400 million. That was a point of maximum pessimism, and over the next 10 years, the Peruvian economy recovered and its stock market index rose by 140 times, which computes to an annual return of 63%. So always remember this. When investing, pessimism is as much your friend as euphoria is your enemy. By now, it must be clear to us that a large part of contrarian investing is about stock picking, and at best, it's about sector picking. Now, the mutual fund industry does offer some schemes which are labeled as Contra funds, and the general assumption amongst investors, including me, is that these funds should be managed in a style that is very distinctive from an index or flexi-cap fund. And in that context, one has to put in a bit more attention when choosing Contra funds to see if these are really fitting the bill. Essentially, there are three things you might want to look for. Firstly, whether the Contra fund operates per the fund manager's unique stock picking and investing style, which would require you to read up more about the fund manager. Secondly, you will need to judge the conviction and imagination factor of the fund manager, including his or her stubbornness to stick with their original premise. Thirdly, as an investor, you need to look at the fund's performance at different points in time, and what you're really looking for is a weak or even a negative correlation between the fund and the broader indices. This last point is very important because this will require you to mend your own behavior. What I mean is, there will be times when the broader indices are doing well, like in a bull market, and that's also the time when the Contra funds don't do as well. You might be tempted to exit that fund based on the recency bias, which is why we believe that a good assessment of a Contra fund will not come as much from examining a quantitative mutual fund ranking system as it will come from an old-style checklist-based assessment of a fund, which includes the qualitative factors and the quantitative factors. In our opinion, a contrarian strategy can act as the ideal counterbalance to one's portfolio, and if this interests you, then do explore ET Money Genius, which is geared to give investors a better than benchmark return, consistent returns, targeted volatility, and a better downside protection. Genius comes with 6 available strategies, and with tens of thousands of subscribers already on board, we would love to see you take the maximum advantage of this service. And with this, we come to the end of this video. If you learned something new today, then do tap onto that like button, do subscribe to our channel, and I look forward to catching up with you next week on another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.